I'm Mortgage Mark. Let's talk about interest rate buydowns. There are two different types. There's what's known as a temporary buydown and then a permanent buydown. So the permanent buydown, guys, let's start with that one. Seems a lot easier. If you've ever heard of points, most of you probably have, and if you haven't, we had a whole video on points and what they are, but points just means you pay money today at closing. In exchange, you get a lower interest rate. That is a permanent buydown. You were paying money today, and instead of getting the rate of here, it's gonna be lower. Set it and forget it, you're done. That's a permanent buydown. That's just paying points. A temporary buydown, on the other hand, a temporary buydown is just that. And there's a couple different ways to structure this, but let's just use what's called oftentimes a 2-1 buydown. And I'm gonna use some very generic, just examples here, but you guys can get the point. A temporary buydown says that your interest rate will start at X. Whatever that X may be, you can fill in the blanks. Your interest rate started at X. But if money gets put towards closing, paid at closing, a lot of times it's by the builder or by the seller. They'll say, hey, here's some money, use it for this temporary buydown. Well, the payments then will be X minus, in this example where I'm doing a 2-1 buydown, your first year is gonna be X minus 2%. So let's just use rough numbers, guys. If rates start at 6%, making up that number, if your rate's 6% and you got a 2-1 buydown, your first year, your mortgage payments are gonna be based off 4% interest rate. So it's really cool. So for that first year, you can get in and the payments will be lower. And that's really helpful because when you're a first-time home buyer, or maybe you're just buying a bigger home that you've never been in, there's a lot of stuff to pay for. Right? You gotta maybe buy that first lawnmower, or maybe it's a bigger house, so you now need that extra couch and the extra big screen. So it helps just create that cash flow that just allows you to kind of get in there and get this, kind of get settled, so to speak. Then the next year, so that's the 2. The second year, in my example, if rates were 6 and they start at 4, the next year it goes to 5, right? It's X minus that 1%. So now your payment's 5%, based on a rate of 5% for that second year. So again, a little higher than what you had, but fundamentally lower than what you could have would have had. It's not until year 3, in this example, that the payments become the quote real payments, the 6% rate. So that 6% rate is then set from there into, on a 30-year fixed rate mortgage, that's what gets set and it's just sitting there forever. If you did a 15-year, it'd be set for the 13 years remaining. So buydowns, when are they good? Why are they needed? Well, look, they're really good in a market like today, where rates have been going up and up and up. So at the time of this taping, it's summer of 2022, and rates have just had the most rapid incline that we've ever seen in such a short period of time. So these buydowns are great because it's like you have to go back in time to get like the rate that was last year, right? It's 2% lower than where we are today. That's huge. Also, it gives you an opportunity that says, man, not only do I get to ease into these payments, but the amount of interest you save for that first 2 years is significant. Oftentimes, even more so than what it would be for the same dollars had they been spent on a permanent buydown. Because some folks may say, well, man, I may do that. I think rather than paying all this money today for this temporary, I might just put the money towards the rate and get a lower rate to start that'll be forever. Guys, the question then is, what does your crystal ball say? Do you think rates are going up? Or do you think rates are going up for a little bit, they may come back down? So my personal opinion, and it's July of 2022, I think rates are gonna keep going up through the end of this year. So this is where you get to that crystal ball, and I don't mind saying it, and this is going on the internet, it's gonna live there, and I could be very wrong, guys. I'm not pretending to know everything, but I've been doing this for 20 years. I do think rates are gonna continue to go up through the end of this year. I think around October, November, and yes, I'm gonna get specific, I think November, December is October, November, I think is when rates will start to spike. That's when they'll hit, because inflation at that point I think will start to hopefully be tamed. We shall see. So these temporary buydowns are great because I do think after that, 12 to 24 months from now, you may see rates come back down. So there's an opportunity to refi. So I don't love the idea of somebody paying a ton of money today for this permanent buydown when they can do it temporary, save more money in the next 2 years with an opportunity to potentially refi in the future. Now again, maybe you never refi, you don't have to. So I know it's a lot for this video, but I really want to make sure you understand what it is. Feel free to watch it obviously again if you need to, but more importantly, reach out to us. Let us run some real numbers for what scenarios you're looking at. Let us walk through all the details and show you how this works. We'll give you a worksheet and we'll arm you with all the details so you can feel really good, but it's a really cool product. It's very good for this moment in time. Find us at mortgagemark.com, and from there you can call us, email us, text us, whatever you want to do. And as always, when you watch this, just let us know how we can help. And when you think mortgage, think Mark.